Hey there, and welcome back to our channel. I hope you're all doing well today. If you're new here, I'm Your Name, and I'm excited to have you join us as we delve into the world of finance. Today, we're going to tackle a crucial topic that affects businesses and personal finances alike: cash flow analysis. So, grab a notebook and let's dive right in. Now, let me ask you a question. Have you ever wondered how businesses keep track of their money? Or how they know if they are financially healthy? Well, the answer lies in cash flow analysis. Understanding cash flow is vital for making informed financial decisions. So, how do we analyze cash flow step by step? Let's break it down. Step 1. Understand what cash flow is. First, let's clarify what cash flow actually means. Cash flow is the movement of money in and out of a business or personal finances over a specific period. It can be positive, when more money comes in than goes out, or negative, when expenses exceed income. This movement is typically categorized into 3 types: operating activities, investing activities, and financing activities. Operating activities include the income generated from core business operations, like sales. Investing activities involve the purchase and sale of assets, such as property or equipment. Lastly, financing activities refer to cash flows from borrowing or repaying loans, as well as equity financing. Step 2. Gather financial statements. Next, you'll need to gather the necessary financial statements. The most important document for cash flow analysis is the cash flow statement. This statement outlines the cash generated and spent during a specific time frame. It's divided into those 3 activities we just discussed. Here's a simplified example of a cash flow statement. You can see that it starts with the cash balance at the beginning of the period, then adds cash inflows from operations, and subtracts cash outflows. The result gives you the net cash flow for that period. Step 3. Analyze cash inflows and outflows. Now that you have your cash flow statement, it's time to analyze the cash inflows and outflows. Look closely at where your cash is coming from and where it's going. Are you generating enough cash from operating activities to cover your expenses? This is crucial for understanding your financial health. For example, if you see that most of your cash inflows come from sales, that's a good sign. But if you notice that a large portion of your cash is going towards expenses that don't contribute to growth, such as excessive overhead or unnecessary subscriptions, it might be time to reassess. Step 4. Calculate key cash flow ratios. Next, you can dive deeper by calculating some key cash flow ratios. These ratios help you assess liquidity and efficiency. A couple of important ratios are the cash flow margin and the cash flow to debt ratio. The cash flow margin is calculated by dividing cash flow from operations by total revenue. This shows you how much cash you're generating from your sales. A higher ratio indicates better efficiency. On the other hand, the cash flow to debt ratio is calculated by dividing cash flow from operations by total debt. This ratio helps you understand how easily a company can cover its debts with its cash flow. A ratio above 1 means the company generates enough cash to cover its debt obligations. Step 5. Forecast future cash flows. Finally, use your analysis to forecast future cash flows. This involves looking at trends in your cash flow data and making reasonable projections. Consider seasonal changes, growth strategies, or any potential changes in your business environment. For example, if you notice that sales typically increase during the holiday season, you can plan for increased inventory and staffing. On the flip side, if you anticipate a downturn, you might want to tighten your budget and reduce expenses. So, to summarize, analyzing cash flow is a step-by-step process that starts with understanding what cash flow is, gathering your financial statements, analyzing your inflows and outflows, calculating key ratios, and forecasting future cash flows. Mastering cash flow analysis can empower you to make better financial decisions, whether you're running a business or managing personal finances. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more educational content. Have any questions or topics you'd like us to cover? Drop them in the comments below. Thanks for watching, and I'll see you in the next video.